Welcome back, everybody. Today, we are putting on our risk analyst and regulatory whistleblower hats for a bit of a financial masterclass.
Absolutely. We're literally pulling back the curtain to expose the structural realities, the vulnerabilities, and the corporate governance bottlenecks in India's financial system.
We are diving deep into today's explainer, problems of capital market.
Yeah, because we aren't just looking at the shiny surface of economic growth here. If you want to know what really threatens the stability of a nation's financial backbone, well, you're in the exact right place.
Okay, so let's just quickly glance at our roadmap for today. First up, the capital market engine.
Then, scams and lost confidence.
Third, insider trading and manipulation.
4 is inadequate debt instruments.
5, inefficiency and volume declines.
And we'll wrap up with number 6, regulating the market. Let's just get right to it.
All right, Section 1, the capital market engine, the promise of long-term growth.
So, look, the ultimate promise of any financial system is actually pretty simple. It's about mobilizing your long-term savings and funneling them into this giant engine that creates real wealth. Exactly. It's supposed to be a total win-win situation. Industrial organizations get the massive investment funds they desperately need to build and expand, and you, the investor, get to sit back and watch your savings grow over time.
Just to set our baseline here, the capital market is, fundamentally, a market for long-term funds.
And that long-term distinction is absolutely crucial. We're talking about both equity, so stocks, and debt, like bonds. And these are raised domestically and internationally to really fuel the whole shebang. Agriculture, trade, industry, you name it.
Right, and where does the fuel for this giant engine come from? Well, it comes directly from individual savers like you and me, corporate savings, banks, and specialized financial institutions. You put your money in, expecting a fair, transparent system to allocate it efficiently.
But, that's just the textbook theory. What happens when that engine is rigged?
Yeah, seriously. What happens when the very system designed to grow your wealth is completely compromised by structural bottlenecks and bad actors? Let's take off the rose-colored glasses for a second and look at the stark reality.
Which brings us to Section 2, scams and lost confidence, the dark side of history. Now, the impact of massive financial scams goes way, way beyond just the immediate dollars stolen. We're talking major corporate frauds and accounting scandals that cause irreparable financial loss to the market itself.
And honestly, more importantly, they act as this devastating catalyst for public distrust. When a massive high-profile scam hits the news cycle, it shatters that foundational trust completely.
And this is exactly why we see such shockingly low retail participation in India. I mean, despite rapid urban growth, a vast majority of middle-class and rural households actively stay away from capital markets. For sure, they'd much rather stick to the perceived safety of traditional gold or fixed bank deposits. The pure fear of market volatility, heavily compounded by these historical scams, just leads to a complete loss of confidence among your everyday individual investors.
Moving on to Section 3, insider trading and manipulation, unfair advantages.
So, let's break down 2 distinct threats that actively gain the system from the inside out. First up, insider trading. This is when sketchy individuals get their hands on confidential, non-public company data and they use it to buy or sell shares for an unfair personal profit before the public ever even finds out. They are, quite literally, flat-out cheating regular investors.
Right, and then on the flip side, you have price manipulation, or what's often called price rigging. Now, this doesn't necessarily rely on secret data. It's all about manufacturing fake market activity. Basically, a group coordinates to buy and sell among themselves just to artificially pump up the share price for their own personal gain. Both of these practices severely crippled a fair functioning of the market.
Okay, Section 4, inadequate debt instruments, the missing wing.
So think of a healthy capital market like a bird. It needs 2 balanced wings to fly, an equity stock wing and a long-term corporate debt wing. But in India, the debt instruments face some severe hurdles.
Yeah, it's deeply underdeveloped. There is a painfully narrow investor base. We just lack the massive institutional buyers needed for basic liquidity in the bond market. Add to that the extremely high cost of issuance and these wildly complex legal procedures, and you essentially lock out small and medium enterprises entirely.
And here's the real whistleblower reality for you. Because the public debt market is so broken, massive companies are increasingly turning to what's called private placement.
Exactly. They quietly bypass the public stock exchanges altogether to raise capital from just a few elite institutional investors. This severely limits transparency, leaves regular retail investors completely in the dark, and makes the public market dangerously reliant on the volatility of stocks.
Let's look at Section 5, inefficiency and volume declines, the squeeze on trade.
Historically, India actually had quite a few regional stock exchanges, but trade volume has brutally centralized over time.
Yeah, investors are heavily consolidating their activity into the premier national stock exchanges, like the BSE and the NSE. And while sure, this centralization offers some stability, it essentially wipes out the regional trading hubs that once really decentralized access to capital.
And we have to talk about data here. So a market is technically considered informationally efficient if a company's stock prices incorporate all the available information into the current prices instantly. That is the ultimate gold standard. But here's the uncomfortable truth. The stock market in India still severely lacks this informational efficiency compared to advanced countries. Prices simply don't always reflect reality fast enough, which leaves a massive window open for inefficiencies and, frankly, exploitation.
Which brings us to our final point, Section 6, regulating the market, patching the cracks. So how does a financial system actually survive these really serious vulnerabilities? Well, through aggressive structural reforms. Let's look at the timeline here. Back in 1992, the Securities and Exchange Board of India, or SEBI, was empowered with statutory powers to act as the tough cop on the block, really stepping in to protect investor interests. And that exact same year, the premier national stock exchange was launched to modernize trading. Right. And then fast forward to 1996, DMAT accounts were introduced. And guys, this was a real game changer. It shifted the entire market away from highly risky physical paper certificates over to secure, computerized electronic share trading.
So, we've seen the deeply ingrained problems, everything from sketchy market manipulation to a dangerously underdeveloped debt wing. And we've also seen the powerful regulatory fixes that have been put in place. But it leaves us with one incredibly vital question. Are these technological and regulatory reforms actually enough to permanently safeguard the retail investor's trust against the next big scam? That constant tension between market evolution and the persistence of bad actors is exactly what makes monitoring these financial systems so utterly fascinating.
Absolutely. Keep analyzing, keep asking the hard questions, and we will catch you in the next explainer.